Okay, I think we'll kick off. Okay, hello everyone, and welcome to today's Employee Ownership Explained webinar, the role of the accountant in the EOT transaction, and many thanks for joining us today. For those who don't know me, my name is Angela, and I look after the marketing and communications for Cooperative Development Scotland. Just before we get started, I'm going to take a few minutes to talk you through details of how today's session will work. I will be your host. Carol Leslie, one of our specialist advisors, will be managing the technology and facilitating the Q&A, and Dougie Ray from EQ Accountants will be our speaker. As an attendee, you should be muted with no live video. You will all have caught sight of the agenda. However, as a reminder, today's webinar will begin with a short overview from me and a poll. Dougie will deliver his presentation, and that will be followed by a Q&A session. Please feel free to ask questions throughout the session using the Q&A functionality. These will be addressed during the session itself. You will also have the opportunity to raise your hand and ask a live question during the Q&A. After the Q&A, there will be a final poll and the session will close. This is the first online webinar that we've done and will be the first in a series of 3. So your feedback will be very much appreciated in order that we can improve for the future. When we close the webinar, a short evaluation should appear. We would be grateful if you complete this. If this isn't possible, a summary of the session and a recording will be sent to you along with the evaluation. So let's move on to my overview. Okay, so who is CDS and why employee ownership? In case you're not aware, Cooperative Development Scotland is a specialist unit within Scottish Enterprise. Our role is to raise awareness of and increase the number of businesses considering employee ownership. We offer our clients an ownership succession review and an employee ownership feasibility study. So why employee ownership? We've seen a real surge in interest in employee ownership since the 2014 Finance Act introduced a new model for employee ownership, the Employee Ownership Trust. However, more recently, we're seeing 3 main reasons for the increased interest in EOTs. Owners looking to retire, a decrease in entrepreneurs' relief, and a potential change to capital gains tax. So what does the employee ownership sector look like? According to the White Rose Centre for Employee Ownership Survey 2020, which was taken in June this year, there are around 470 employee-owned businesses in the UK, with Scotland second only to London in terms of growth of employee-owned businesses. According to the CDS database, there are over 120 employee-owned businesses operating in Scotland, with a combined turnover of around 900 million and 7,500 employee owners. With regards to transactions, there have been at least 9 sales to EOT this year alone that we're aware of. The Scottish Government has an aspiration for the sector to 500 employee-owned businesses by 2030 and has set up a public-private partnership industry leadership group called Scotland for EO, which CDS is part of. And finally, I'd like to share some examples of UK and Scottish employee-owned businesses. Okay, so before I hand over to Dougie to deliver his presentation, we'll conduct a short poll of 3 questions. This is really to gauge knowledge in the audience. We'd be grateful if you could respond to this. So your 3 questions should be up on the screen. If you kind of scroll down, you'll be able to review all of them and submit your answer. Okay, thanks for replying. I think we'll go to the responses.
Angela, still votes coming in, so just give it another second.
Yeah, sure, not a problem.
Okay.
There we go. So, not surprisingly, our biggest attendee today is the accountant. Thanks for joining us. And again, interesting that actually the majority has no direct experience of implementing an EOT. And then finally, again, it's quite surprising, again, a kind of basic knowledge of EOT. So again, thank you very much for joining us today. Hopefully your knowledge levels will be increased after Dougie's presentation. And I'm now going to hand over to Dougie for him. Dougie, you can put up your presentation. Again, for those who don't know him, he joined EQ Accountants as a qualified CA in 1998, having trained with a large international practice. He's the firm's audit compliance principal. He's worked in many employee ownership trust transactions, including Exmos, GS Brown, Harvey Maps, and Palimpsest. Over to you, Dougie.
Hi, good morning, everyone, and just welcome along to the presentation today. I'm just going to cover a few areas on the role of the accountant in an EOT transaction. Just obviously a small disclaimer first. Obviously, this is a training session, and every company will be different, so it's important you do look into the position for each company and take advice rather than following necessarily what's covered here. So I think just to start off, I just thought I would say actually what an employee ownership trust is. So it's a special type of employee benefit trust, which obviously sends a shiver down some people's spines. But this is government sponsored, for want of a better phrase, and it was brought in to encourage employee ownership for companies throughout the UK. And provided that the structure that is put in place as part of the transition, there's very generous tax relief available for the shareholders who transfer their shares to an EOT. Now, obviously, the big headline is 0% tax. There's no capital gains tax payable by the vendors when they sell their shares to EOT. And hopefully, as we get through the next few budgets, that 0% stays in place. But I wouldn't recommend that purely this tax issue or tax advantage is why somebody should transfer into employee ownership. There needs to be other reasons for that as well. But one of the main positives of this transition is that the owner can stay in the business, which isn't always the case when the business is sold to a third party. The original owners might be able to stay perhaps as consultants, but typically there's obviously usually going to be changes brought in by the new owners. And what's a positive for the employees and for the customers and suppliers is that in this scenario, it can very much just be business as usual. There's a few types of employee ownership schemes. There can be schemes where the employees actually own shares directly in the company, as well as there being a trust. But for today's presentation, I'm just really going to concentrate on the position where the trust itself owns all the shares on behalf of the employees. So what are the eligibility criteria for this transition? There's a trading requirement, so it needs to be a company that is trading, so this isn't for investment businesses. And it's important that you check that the company you're looking into does qualify as a trading company using HMRC rules. And then there's a controlling interest requirement. So before the trust is put in place, the trust can't hold a controlling interest in the company. But once this transition takes place, it must hold the controlling interest. And that has to be by the end of the tax year in which the transfer takes place. So if you did it at December 2020, say, as long as the trust owns the majority of shares by 5 April 2021, then this should qualify for an EOT transition. The controlling interest is just over 50% plus. So clearly the shareholders that have the shares at the moment don't have to sell all the shares to the EOT straight away. And that could be important for the current shareholders. If you've got a company where there's maybe age differences between some of the directors and shareholders, you could have someone looking to retire who's wanting to sell all the shares straight away. but perhaps some younger directors who are looking to continue to hold some shares and benefit directly from the growth in the company. But the thing to keep in mind is you only get one bite of the cherry in this scenario. The 0% rate only applies in the tax year where the transition takes place. So if you're holding on to shares and selling them after that tax year, so in the scenario I was discussing, 5 April 2021, after that date, you will then fall under the remit of whatever tax legislation is at that time, whether it be the business asset disposal relief that we'll have just now, or whatever HMRC have in place at that stage. So that's one thing to keep in mind. There's a few other eligibility criteria. There's the all employee benefit requirement. So all the employees must share equitably in the trust. You can't cherry pick and benefit certain employees. If you were wanting to do that, it's probably where you would use an EMI scheme or something like that, obviously with the company's approval. Now, you don't have to pay everyone the same. You can carve it up in different ways, which I will come back to. There's also the limited participation requirement, where with regards to the selling shareholders and any people connected with them, the company can't have more than 40% of those people involved in the company thereafter. That was put in place just to make sure that it's a true transfer to employees. So it's not for small family-run businesses just looking for a tax-efficient way to get their money out of the company. This can't be used for that. I mean, going back to the employee benefit, I mean, one of the highlights that people are aware of is that employees can be paid a bonus up to £3,600, which is tax-free, but not national insurance free. Just to flag up, that has to be a bonus. You can't suddenly put in a salary sacrifice scheme and supplement it with this 3,600. But as I was saying earlier, you don't have to pay everyone the full amount, and you don't have to pay everyone the same amount. It can be carved up on the basis of, say, as I've said, their length of service or salary, and equally it doesn't have to be the full 3,600. And you would imagine that in the early days, where you're actually looking to pay out to the original shareholders, the vendors, that the level of bonus will be a bit lower compared to further down the line. There is just one last eligibility criteria, so you can't have any related disposals. So this can't be a chain of transactions, if you like, and you can't play around with the structure of the company to try and use this tax relief on more than one occasion in the same group. So moving on from that, so what are the tax implications? As I've said before, there isn't any capital gains tax arising on the transfer to the EOT, which is absolutely great, obviously. I would advise you to ensure you get clearance from HMRC to ensure that the 0% rate applies, and you do have to avoid disqualifying events once the transitions take place. This is about accountants, and I would say arguably the main role of the accountant in this transaction is ensuring that the process and the rules regarding the transition are being followed, and it's the accountant's role to put the case to HMRC as to why this is a bona fide transition to employee ownership, and it should be allowed to take advantage of the tax breaks that are available. As part of that clearance, you'll give details of the company, of the transaction itself, so who's actually taking part in it, what levels of shares are being transferred, how it will be funded, and also to confirm that it meets the various eligibility criteria to gain clearance from HMRC. I'd also recommend that you provide the valuation, trust deed, even if it's in a draft format at that stage, and the SPA, I always find that if you give HMRC as much information as possible up front, they're less likely to come back and ask questions or challenge any transaction taking place at a later event. Just covering off the disqualifying events, it's pretty much just the reverse of what the eligibility criteria are. So what would happen if this happens within the tax year where the transition takes place or the year after, then it'll fall on the sellers to pay any capital gains tax. So that's if the company ceases to trade, if it fails to meet the controlling interest, if for some reason some of the shares are sold to a third party, say, if the employee benefit requirements aren't met or the limited participation requirements fail. So for example, if it was a smaller company and some staff leave, so you're left with a whole load of family members in there, then obviously that causes an issue. And as I say, up to the point of the end of the tax year, after the year of transition, then it will fall upon the sellers to pay any capital gains tax that arises. Now that might be covered off as part of the SPA agreement, but that's up to the lawyers to get that in place. But these disqualifying events don't disappear. I mean, after that period, if a disqualifying event does take place, then it will fall on the trust to pay any capital gains tax that arises, and it might actually fall to the trustees. So I suppose the question is, should trustees actually be concerned in this scenario where there could be this capital gains tax bill that arises for them further down the line? Obviously this is quite new, and I'm not sure if it's been tested out yet, but it is expected that if that event happens out with the trustees' control, then there wouldn't be any personal capital gains tax liability falling upon them. But as I say, I'm not sure if that's actually been tested in law yet or not. I did say at the start that there's some schemes that can be set up where the employees have a direct shareholding, and obviously if there's any disposal by them of those shares, then they'll have their own tax considerations to consider as well. Company valuation, it actually isn't any different to if you're selling to a third party. So normally it would be a multiple of net profits or EBITDA, depending on what suits your company better. And I did allude to it earlier, I would include the valuation methodology when you're giving the clearance application to HMRC. You're not necessarily asking them for clearance on the figures, but again, I feel that if you're giving them as much information as possible at the start, they're less likely to come back and challenge anything further down the line. It's important that the owners are realistic with the valuation of the company. They shouldn't see this as a way of boosting the monies and the proceeds that they'll receive, because they've got to remember this does have to be paid for, and more often than not it's actually to be paid for by the company from future profits and from future cash available to them. But one of the good benefits of the employee ownership trust route is that it can be seen as a friendly sale, if you like. You don't have a third party sort of picking their way through the accounts of the company, picking their way through the books and records, trying to find a way to drive the price down. There's a couple of other areas that were listed that I haven't actually necessarily put a slide together for. Funding options, I think at the moment it is still quite hard to get external funding for these type of transactions. The banks are improving. I think the more that these EOTs are taking place and the bank understand the mechanics behind it and see these companies flourishing, then the banks are more open to lending than have been in the past. But they are still, they still like to have the security in place, and that will depend on what the company has available. There are a few specialist lenders out there that will lend for these transactions, but as you'd expect, quite often the costs are quite a bit higher than for normal lending from banks and things. So I do think that realistically, the company will end up having to fund these sort of transactions themselves for a while yet, as I say, based on future profitability and having bank funds available. The other area was vendor loans, was how it was described. And to be honest, none of the transactions I've worked on have actually had formal loans put in place. They've all been based on deferred consideration payable over a period, and that's included in the SPA agreement that the lawyers produce. As I say, it's been deferred consideration, but I'll be interested to see what the effects of COVID are on future deals that are put in place. Keep in mind that it's the trust that owes the money to the original shareholders, not the company itself. And if you do put any formal loan paperwork in place between the company and the trust, then that's going to crystallise it in the company's records, and realistically the net asset value of that company is probably going to shoot down quite rapidly and no doubt affect their credit rating and their ability to trade going forward. To avoid tax issues for the trust, the company normally gifts the monies to the trust rather than paying it as dividends, which would be income in the trust's hands. As I say, keep in mind that that's got to be done from available reserves. It's not just a matter of having that money available in the bank to be able to transfer it across. So really, we are looking at companies that are going to be generating profits in the future and having the cash available. However, from the owner's point of view, or the original owner's point of view, that lack of security or that lack of loan agreement in place is putting trust, if you like, in the company and being able to continue going forward. And as I say, I do wonder if people might be a bit more wary of that on the back of what's happened with COVID with the various companies we have. The last thing I was going to talk about was actually the long term for the trust. We've talked about what's happening with transferring it into and sort of the early days, but over the long term, you've probably got three obvious scenarios. Either the company continues forever to be employee owned and everyone benefits from it. Company unfortunately goes bust and there's nothing left of it anyway. Or the last scenario is that the company is sold. So the trust and the trustees decide to sell out to a third party. Normally that will be covered in the trust deed as to how that will come about. It might be that, for example, 80–90% of the employees have to agree to a sale of the company to a third party, but it could be that's somebody's come in with an excellent price that the employees want to sell to those buyers. What you would normally expect, as I say, is that once the trust has paid for any legal expenses in relation to the disposal and any capital gains tax, which will fall on the trust, either what we've come across normally is that either it's set in that the net proceeds will be distributed to the employees, and again that can be done on a basis based on salary, share, or length of service, something like that. Or it might be that the original owners wanted the monies to go to charity, perhaps a local charity, to benefit the area, or it could be a combination of the two. As I say, that's probably covered as part of the trust deed when the trust is initially set up. Okay, that's me. I'll hand back to Angela now.
Okay, many thanks, Dougie. Going to move on to the Q&A session, which Carol will manage for us. Looks like we've got a couple of questions in just now.
Okay, thanks Dougie, thanks Angela. So we have a few questions in the Q&A, and if anybody wants to ask any other questions, please you can do it by using the raise hands function. Dougie, the first question that we have here is from Krista, Cameron & Co. Are the employees themselves required to put funds into the trust?
No, not at all. As I say, typically the deals that I've been involved with, the company is the one that gifts the money to the trust, and the trust then pays it down to the vendors. As I say, I suppose if the employees are taking part in direct ownership of the shares, maybe through a SIP or something like that, then there could well be a requirement for them to put some money in, which might be drawn from their monthly salaries, things like that. But certainly in the deals that I've dealt with, purely been on the basis of there being a trust at the top that owns all the shares on behalf of the employees, and employees haven't put any money into those deals.
Okay, thank you. Dougie, a question from Robert Scott. Are you seeing the EOT being implemented more across any specific industry or sector?
No, not at all, actually. I mean, the four that Angela mentioned at the start are all really quite different businesses. There's been IT companies, there's engineering companies, actually a couple of them are publishers there. I don't think it suits itself to any industry, to be perfectly honest, and actually any size of company as well. I mean, I think the smallest one I've dealt with was probably about 8 or 9 employees, and some of the larger ones at the time are probably a couple of hundred. So no, it suits itself to any industry.
Okay. Andrew Sloan of Bruin Dolphin says, thanks for a great presentation. From your recent experience, do you find business owners have undertaken sufficient personal financial planning when considering their exit? And in light of quite a long question, and in light of a low yield environment, do they know how best to manage their net proceeds as a transaction completes?
To be honest, the ones I've been involved with for the vast majority haven't actually originally been clients of EQ. We've only been involved in dealing with the employee ownership transition. So I've not really been in a position to quiz them on their personal affairs. But certainly we'd encourage the vendors to consider their full financial position as part of this. This is usually done as a retirement plan effectively. So yeah, obviously they need to make sure they've got everything lined up and have a good understanding of what their total proceeds will be, or their total income in future.
Yeah, and I would probably, I would agree with that. I would pitch in with, in my experience, I think there's not enough planning done of the overall financial landscape for business owners when they're considering this. And it's probably something that we should be recommending. Question from Andrew Holloway of Johnson Carmichael. Another thanks for the presentation, Dougie. On valuation, have you seen HMRC challenge or request any further detail on methodology or the multiples used?
Genuinely nothing at all. I've never had any question from HMRC. I think there's 2 reasons for that. I think because the government are very pro employee ownership, they're less likely to start picking through it all. But as I said as part of the presentation, we do encourage business owners to be realistic with their valuation. So personally, I don't think I'd be putting in any sort of clearance application if I felt that the valuation was far too high and not justifiable. And as I say, you've got to remember that it's actually the company is going to be paying for it. So if the director, the shareholder is staying involved in the business, he needs to justify in his own head that that money is going to be getting taken out of the company on a regular basis to be paid to him. So the vendor probably does have 2 hats in that scenario.
Okay, thanks. I think we've got a question from Anne Blacklock. Anne, are you there? Oh, you'll have to unmute.
Hello, yes, thanks very much. I really enjoyed the presentation. I was wondering, Douglas, if you would agree that a hybrid model could be a really good option for a family business owner, perhaps, you know, retiring and maybe having a couple of sons in the business, you know, second generation, giving them 49% of the shares and the trust 51%. Because, you know, in my experience, family businesses really care about what happens to their employees, and you know, they don't want a trade sale. I think this is a good model. I just wondered what your thoughts were on that.
Yeah, I mean, certainly a lot of the businesses that we've dealt with, Actually, I'm not sure if there's been any. I think there's maybe only been one where it was actually a full 100% of the shares were paid across to the employee ownership trust on day one. Quite typically, the original owners will hold on to a percentage of shares to share in the future. And then I suppose they have the choice to then pass that on to family as well. And there is an argument that maybe giving the employees direct ownership of the shares gives them more buy-in to it, but it's a harder model to administer. So you need to keep that in mind as well.
Yes, okay, thank you very much.
Okay, thanks for the question, Anne. A question from Rachel Tate at Johnson & Carmichael. What if the seller's expectations of value are too high?
Well, I think that's just a difficult conversation you have to have with them, really. As I say, you have to be comfortable as the accountant, when you're making the clearance that, well, I feel you should feel that valuation is justified. And you do need to flag up to the owner that it's the company that's effectively paying for this. So it needs to be generating profits, it needs to have the reserves available to pay it, and they need to be realistic in the valuation that they're going to get from the company. I've not had to have that conversation, to be honest, so I think most people realise it. Sorry,
Dougie, so has that not come up in your experience yet?
No, not yet, not personally. I've not had to sit down and have a conversation. I've had one where the business owner had a valuation prepared, and then by the time these transactions can take a little while to go from initial discussions through to actually this is what we're going to do, while they get their head around how it's going to work. And I think by the time the valuations were based on projected figures, and then when they actually got to the year end, the figures were quite a bit lower. But the owner still had that initial figure in his head, and I had to explain to him why I said that wasn't justifiable anymore, and prepare another valuation, if you like, and talk him through that. But I've not had a situation where I've kind of had to lock heads with an owner as to, sorry, but your business just isn't worth that, effectively.
Yeah, so generally you find people are quite realistic when it comes to value.
Yeah, I think so. Because I think, again, as I was saying at the start, it's not about the 0% tax rate. I generally have found that the owners that are doing this want to do it for the benefit of employees going forward. So they appreciate that they've got to leave a value in the business for the employees. And okay, they've got their retirement plan in place, but I think that they're not necessarily looking for as much as they can squeeze out of the company, if you like. I think they are much more of a mind to get a reasonable value out of the business. I've heard the description used before that a lot of these business owners live in the area and want to be able to walk down the street without having any sort of challenge from ex-employees, kind of thing. They want to be able to walk down the road with their head held high, that they've done a good thing for the area.
Yeah, no, I've heard that. Another question from Rachel. Is there a corporation tax deduction for the tax-free bonus?
Yes, there will be. It's paid out by the company, so it's like a normal salary effect. So yeah, you get the bonus for that. There's no corporation tax deduction for the gifting across to the trust. That's I suppose similar to dividends in that sense. You get no benefit there.
Okay. And another question from Scott. What sort of likely timescale is involved from start to completion of a typical transaction?
That will very much depend on the vendors, I would say. You can, if the vendors know what they want to do and are very focused on getting the process dealt with, then you could be looking probably a couple of months, I would say. If you've got a scenario where there's more than one vendor, so they need to decide between themselves as to how it's going to work. Excuse me. they need to have to put the time aside to actually look at the paperwork. It's looking at the trust deed, looking through the SPAs and be comfortable with in there. If, as I say, if they put the time aside and look at that as soon as it's sent, then you can deal with it quickly. But obviously they're running their own companies as well, so sometimes these things can take a bit longer than you would want. So I would say at a minimum, yeah, a couple of months is probably a reasonable time scale, but it's an open-ended scenario in that sense. But as I say, it's more about the vendors being happy and understanding the process, with speaking to the employees at the right time, that sort of thing, getting that all lined up in a row.
Okay. Would you say it takes any longer, or is it shorter than your normal kind of acquisition?
Certainly shorter, because there's no due diligence taking place. There's, as I said, there's no third party buyer who's going to troll through everything trying to strip down. Quite often there's only one set of lawyers involved. Obviously you recommend, and the lawyers recommend, that the vendors take separate legal advice, but typically the vendors are comfortable that with the way this transaction's set up, that they don't have to do that. So that there aren't, no offence to the lawyers listening, there aren't lawyers sending it back and forward to each other on a number of occasions to pick through the various warranties and things. So yeah, I would certainly say it seems a much quicker process than a third party sale would be. Okay,
thanks. There's a question of an exit. The net proceeds are distributed to employees. Are they subject to employment income? Or are they employment income?
No, my understanding is that because the trust is taking the corporation capital gains tax hit at the point of selling shares, that the net proceeds being distributed to those employees should be tax-free. Again, I suppose that could well depend. Is that not correct?
The ones I've been involved in, no, the employees have had to pay income tax and what.
Have they?
Yeah.
So yeah. I've not actually been involved in one of this.
Yeah.
Right. Okay. Well, I apologise for that then. Yeah. So by the sounds of it, there will be income tax at the end.
Yeah. Okay. Stephen Clark from Morton Fraser says, thanks for the presentation. Who do you normally see driving the transaction? Presumably the vendors are pushing a transaction as a means of obtaining a sale. Yeah, I mean, I'd say that the vendors are the ones that are initiating the transaction, if you like. Well, on the basis that the vendors are the directors as well, effectively. Yeah, it's usually them that are driving it initially. They do need a lot of sort of prodding to make sure that they stay on track and deal with it in the timescales you're trying to meet. And that's what the advisors are there for, just to keep their eye on the ball. Yeah, so sometimes I'm approached, and I'm sure Angela's team at CDS are as well, they're approached by maybe senior managers or employees who are trying to push a sale to an employee ownership trust through. But unless the majority shareholder is in favour, it's just not going to happen. They're the ones that are in control of it. Okay, a question from Josh King. You mentioned earlier that the shares, bonus, dividends should be based on factors such as time served or salary. Can you provide some further examples on how this works in practice?
I'm not sure to say much more than that, really. I mean, as I say, the bonus, in some ways, the bonus is unfortunate that it does hit the headlines quite quickly. And it's something that employees perhaps focus on as well, as to what they're getting out of the employee ownership transfer. But obviously, if the company is having to pay out to the vendors over a period, then it could be, the monies can run out quite quickly if they're paying bonuses and paying out to the vendors. So typically, towards the start, there's not a large bonus getting paid out to employees. And you can have scenarios where actually new employees don't qualify until they've served certain amount of time, for example. So you might say you've got to be employed for a year before you can benefit from this. This is typically driven by the directors with the agreement of the trustees, as well as to how much is paid. As I said, yeah, I mean, the longer serving employees might receive a higher bonus compared to the people just in the door. I mean, normally you find that people's salaries might increase depending on how long they've been working there anyway, so you could use the salary in the same sort of way, like almost like a percentage of what the gross salary is can be used. And it's more about making sure that everyone's being treated on the same basis. As I say, you can't cherry pick that a certain team, for example, or certain key individuals are benefiting from the employee ownership bonus being paid out. That's where, as I say, you would use EMI schemes or something like that if you're wanting to reward them separately, or you just have a scheme away from, or a bonus scheme rather, away from the employee ownership scheme.
Yeah, it's an interesting question. It's something that I'm a trustee with a number of employee-owned companies, and I come up with this quite frequently. And first thing, I agree with it. In the beginning, usually the priority is to pay down the debt, and therefore there's not a lot of spare cash to pay out to employees. So bonuses, if there are any, tend to be quite low in the early days. And in fact, there's a couple of companies that I've worked with where they've actually put it to the employees at regular meetings. They have to say, you know, we've made more money than we thought we would this year. Will we pay it out as a bonus, or will we repay the vendor earlier? And in both cases, unanimously they decided to repay the debt. So that employees want the company to be debt free. So I agree with that one. When it comes to how you split the bonus, it's interesting how quite often people automatically jump to thinking if it's split absolutely equally, that's the fairest way to do it. But then when you take in different lengths of service, part-time, full-time workers, etc., then it's not quite as clear-cut as that. And most companies probably assess it differently every year. So sorry, Josh, it's not something that we can give a definitive answer on, because I think every company is different in how they approach this. Josh has come back with a follow-up question. So a bonus based on performance would be another bonus structure out with this. I think, yes, your remuneration policy is untouched by the fact the company would be owned by an EOT. So you can do whatever you want in terms of remuneration. The regulations only stick with the EOT bonus, as we tend to call it. Okay, a question from Neil McDonald. Neil, congratulations on your win of Director of the Year recently. Neil's question is, how do you see the Scottish Government supporting this, and how through the Scottish Investment Bank or others? What I might do is ask you this question, Dougie, and then I might ask Angela if she's got a view on it.
Okay.
I'm not sure, to be honest, what the Scottish Government policy is on it. They're obviously very supportive of it. I've actually not come across any scenario where a vendor's gone to the Scottish Bank to ask for any sort of investment towards it either. So generally don't know, actually. Angela, you might have a better...
Yeah, again, certainly just to echo you, Scottish Government is obviously very pro-employee ownership with the launch of the Industry Leadership Group and other initiatives like that. And again, Carol, you might be better placed, but obviously some transactions are financed by banks or other facilities, and again with the Scottish Investment Bank and obviously Scottish National Investment Bank, that there may potentially be funds in the future that may be open to this, but certainly it's one of those things that there's no policy there at the moment, but certainly a commitment to the growing of the sector. So who knows what will come in the future.
All I could add to that is that all the parties in the Scottish Parliament are supportive of employee ownership, and there is a move, I think, coming from Scotland for Employee Ownership to encourage all of the parties to include a commitment to employee ownership in their manifestos for the Holyrood elections next year. So it's one of my frustrations about the politicians is it's because employee ownership is such a good hook to hang your hat on that there's a lot of lip service to supporting it, but we don't often see that translated to actual action. There has been a few questions recently about the second guessing what's going to be in the autumn budget, and I'd be very surprised if EOT tax relief was touched. I don't know if you've got a view on that, Dougie.
Yeah, I'm in the same boat as you. I mean, obviously, I appreciate that they need to get tax revenues up and get them in. It would be quite a U-turn given how pro-employee ownership they've been to suddenly start taxing it, certainly at the next budget anyway. I can see changes being made to the business asset disposal relief, but I think the EOT relief will be left for a period. As I say, if business asset disposal relief gets worse, then they might look at employee ownership down the line, because it will still be a favourable tax rate. But no, I think certainly for the near future, I'm certainly hopeful that the 0% rate will stay in place.
Actually, we missed the most important support that we're getting from the Scottish Government, and I think that's the CDS. And I think it's the efforts and actions and initiatives that come out of the CDS, which is part of Scottish Enterprise, that results in Scotland being much further ahead than the rest of the UK and many parts of the world in the way that employee ownership is promoted. I think we're quite unique in Scotland to have that body who is government funded and who are particularly directed to promote more employee-owned companies in the economy. So I guess that's quite a strong level of support from the government.
Yeah, I would just echo what you're saying there, Carol. Certainly, we're seeing a surge in demand, probably like yourselves, in terms of interest from companies, and certainly as long as all the benefits are there, I can see the sector growing at a really significant rate.
Yeah, good. Okay, question from Kieran McIntosh. Can an EOT still implement tax advantage share schemes, for example, growth shares or EMIs?
Yeah, absolutely. We've dealt with a few where there's been an EOT put in place and EMI schemes have been sort of put in tandem. Obviously, you've got to keep an eye on the controlling interest requirement. So if you start off your EOT with only 51%, for example, putting an EMI scheme could well leave you with a disqualifying event once those options crystallise. But yeah, they work quite smoothly. It's obviously up to the company and ultimately the trustees to approve those schemes, but yeah, they work fine together.
Okay, thank you. Next question from E. Davis. Now, this is directed at you, Dougie. I could probably pitch in something, but we've also got some people from banks in the audience if they want to raise a hand and answer. Hi, Dougie. Have you seen any transactions where bank funding has been available to support the transaction? Would this be raised by the company and then gifted to the trust, or can the trust raise the debt itself?
Personally, no, I've not dealt with any where the banks have been involved. But as I say, I would imagine that it'll be the company that needs to take the borrowing, because the trust won't have anything for the bank to lend against, effectively. So my expectation is that the company will need to raise the funds and then gift it across to the trust to then pay down to the vendors.
Yeah, and that's exactly what's happened in the transactions I've been involved in, where there's been banking, a debt coming from the bank, where it's been the company that actually borrows the money and then gifts that to the trust and pays it out that way. The trust not really having assets other than the shares, I don't know that lenders would be willing to lend on that basis. A question from John Fairgrieve, maybe a crazy question, but if dividends are declared by the trading company, presumably the EOT then acquires a share of the total dividend pot, as well as payments to the original shareholders who still hold a small percentage of share capital.
Yes, that's right, and that's one of the reasons why the company typically gifts money to the trust rather than paying it by dividend, because if there's any other dividends, any other shareholders rather out there, then they're entitled to dividends. I assume it's always the same share type, of course. So you've then got the issue of paying out more money from the company, or them having to waive dividends, which I know HMRC aren't very fond of. And also that would then mean trust has income, which is then taxable in the hands of the trust. So that's why we tend to avoid any sort of dividend being paid out to the company, and it's all done by gift.
Yeah, okay. Hope that answers your question, John. A question from Rupert Tussaud. What level of due diligence is typically performed on behalf of the EOT to protect their interest prior to the transaction completing?
Sorry, is this at the point of creation of the trust, or is he talking about at the end? I don't know.
Well, I guess it's prior to the creation of the trust. My experience is the due diligence is actually quite light touch, because you're picking up an owner managed business and the owner does tend to know everything that's going on and is usually not leaving imminently, and therefore have to manage any situations arise. So I would say it's quite light touch due diligence. Yeah,
absolutely. It's usually, I mean, it's really down to valuation more than any sort of real, as I say, getting under the bonnet of the company.
Okay. I think we'll just take the last two questions. That means we won't run out of time, Angela, if that's okay. So next, penultimate question, is there full transparency to all staff of salaries in an EOT, and does this cause any difficulties? I can take that if you want.
Yeah, that's fine. If you take that, Carol.
It's very, very unusual for there to be true complete transparency of salaries. Salaries tend to be viewed as personally confidential information, and it's just like any other company, it's not usual to share that. What you do find is there's more maybe transparency of corporate information. Employees would have more access to the company's accounts, for example, but personal information tends not to be shared very widely. And a question from Anne Blacklock. Angela, this one will be for you. Can you please remind me of the current CDS level of support to interested parties?
Yeah, sure, Anne, I'll take that one. Basically, at the moment, what we offer any business owners considering succession is, first of all, an ownership succession review, where they'll review all their options available to them. And should employee ownership be the favoured option, or one that they would like to explore in more detail, we can then offer them an employee ownership feasibility study, which will basically take them to the point where they can make a decision on whether employee ownership is the right route forward or not. And again, Carol here is obviously one of our specialist advisors who actually delivers our kind of feasibilities and reviews. So I don't know if there's anything you want to add, Carol, but yeah, that's certainly the level of support that, that CDS provides at the moment.
All I would add is I find that that service to be really useful for helping business owners in their thinking time. It helps clarify what their options are, and if employee ownership is the favoured method, the feasibility study sets out what the potential model of that could be and what the process would look like. And I think that helps solidify thinking. And it also helps if the business owner's looking to bring maybe some of their top team into their conference. It gives them it down in black and white. So I think it really does help decision making. It's a useful service. And there's absolutely no obligation to go any further with it. It's just, I think, helpful research for information.
Yeah, really just to add, it is a free service, so there's no cost to the business. So it's certainly something that we would recommend to all interested parties.
And I think there's 5 different parties on the framework, isn't there? So
yeah, we have a range of specialist advisors who delivers on our behalf, and a range of experts across all sizes and sectors of business.
Okay. Can I just then finish up this piece of the presentation with a short poll? And can I ask you to answer the poll on your screen? Okay, 2 questions here. What do you believe stops business owners from considering the employee ownership trust as an exit route? The question 1. And the second question, how likely are you to discuss a sale to an EOT with your client considering option? And that question is obviously directed to advisors. Now that's interesting. Lack of awareness is still the leading reason for people not taking this route. Now let's just share the results. Okay, so you should be able to see on your screen, 62% of the respondents are saying it's a lack of awareness. Lack of leadership management capacity, that is an issue. I don't think we're particularly good in the SMEs in Scotland at developing the next layer of leadership. And encouragingly, 45% believe that they're very likely to put the EOT option forward when they're looking at having conversations on succession with clients. Okay, I will hand over to Angela.
Okay, just before we close, I'd really just like to thank Dougie for his presentation today, and obviously to Carol for participating in the Q&A and managing the technology for us, and obviously to all the attendees for making the session today. I hope you found it useful. And again, it's just really to echo, if any of your clients are interested in exploring employee ownership, CDS will be more than happy to talk them through their options. Also just wanted to remind you about our next webinar in the series, which is taking place on Wednesday, the 21st of October at 10:30. This is the role of the legal advisor in the EOT transaction. And we're also hosting a masterclass next week that might be of interest to you or your clients. It will feature employee-owned business palimpsest and one of our succession experts, who I believe is Carol. And that takes place on Tuesday, the 22nd of September at 10 AM. It's called Selling Your Business, Find Out Why Palimpsest Became Employee-Owned. And then really just finally would like to say a short evaluation should appear at the end of this webinar. Be grateful if you could complete this, and a summary of the session and the recording will be available, and the evaluation will be resent just in case you don't receive it directly. So again, that's it from us. Wishing you all a good day, and many thanks for attending, and I hope you found it useful.
Thank you.
Thank you.
Thanks everyone.